Hello my dear learners, welcome back. We are learning the DYPMS Semester 5, the Commodity and Derivative Markets. In the previous lecture, we had learned the introductions of the commodity market and the derivative market. Now today, we're going to learn the Unit 2, the Chapter 3, Future. In this chapter, we covered the meaning of the future, characteristics of the future, the sub-terminology related to the future market, and the concept of the conversion, where we talk about the arbitrage, contango, and the backwardations. And finally, we will going to learn the future pricing model, that is the cost of carry model and the expectancy model. So let's start. So let's start the definition and the meaning of the future. A future in the financial market is a legal agreement between the parties, that is the buyer and the seller, for the underlying assets or a security for the predetermined price in the specified time in the future. So, the future market, if any person entered in the future contract, so both parties have predetermined the price and the time for the future contract. So, again I revise, a future contract is a contract of the buyer and the seller in which the formal to be buy a specific number of the share at a predetermined price at a specific time for the future. So every contract is regulated by the stock exchange or the clearing house, which is and the agency that looks after the asset that traded on the stock exchange. There are the differences between the option and the future contract, but the future contract is more easily traded. For the above, you must have understood about the future theoretically. Now let us understand by the practically, and I'll give you one example. For example, if someone want to buy a September crude oil future contract, so they make a future contract that they will be buy 200 barrels oil from the agreed price as of the September's expiration, whatever the market price at the time in the September. The seller is also agreed to be the sell those 200 barrel of the oils at the time or agreed period of price. Now, in this case, the both seller and the buyer are obliged to the buy or the sell the 200 barrel of oils unless they are trade with the others buyers or the seller. So the traders can also be buy the future of stock, index, funds, foreign currency, exchanges, etc. So this is the simple example where the one buyer need to be the 200 barrels of oils and the seller is agreed to sell this buyer to 200 barrel of oils in the month of the September. So these are the come together in the agreement and the buying and selling of the product or underlying assets. So let's segment is the characteristics of the future market. The first characteristic is there are two parties. Of course, there is the agreement between the buyer and the seller. So there must be two parties. Now the second one is organized exchange. So futures are the trader in the organized exchange with the designated the physical location where the trading taking place easily. So this provide the ready and the liquidity market in which the future can be the bought and the sold at any time. So the stock market exchange